Now girls, with this now I reach illustration 56 in my textbook. This illustration 56 says the following. I am reading the question here, just follow here. The following is the balance sheet at 30th September. It must be 31st March in your textbooks. On 30th September, that does not make a difference. There is no interest in drawings that we have to calculate. So date does not make a difference in this question. On 30th September 1990, of A and B, partners are A and B, who are in partnership and share profits and losses in the proportion of 3/5 and 2/5 respectively. That means 3:2 is the profit sharing ratio. And then they detail the details of the assets and the liabilities on that date. 56,310. These are the as freehold property, machinery, plant, furniture, stock, debtors, investment, and the total has been given. Further, then it is said that they admit C into the partnership from 1st October 1990. The terms, it could be 1st April in your textbook. You just follow these dates here. The terms of agreement are as under. C. Now concentrate on the terms of agreement. C is to bring rupees 6,000 as his capital. C is bringing his share of capital, and rupees 4,800 for goodwill in order to get 2/7 share in profits. He is getting 2/7 share in the profits. Remember, he is getting 2/7 share in the profits. This is his This is his share of capital, and this is his share of goodwill, which he is bringing in cash, and he is getting 2/7 share in the profit. That means after C's admission, we have to calculate now the new profit sharing ratio to find out the sacrifice ratio. We have not been given any hint about the sacrifice towards C made by A and B. With the new ratio and the old ratio, we have to find out the sacrifice ratio. Further, it is said rupees 4,800 paid by C to be credited to the loan accounts of A and B in respective proportions. Freehold premises is undervalued by rupees 5,000. Machinery and plant is overvalued by rupees 500. Remember, freehold premises undervalued. That means we have to increase freehold machinery. Plant and machinery is to be reduced. Debit side reduces the assets. Credit side increases the assets. Remember all these things that are required to make the revaluation account. Further, it is said stock to be discounted at 10% and provision for doubtful debts be reduced by rupees 1,000. Provision to be reduced by rupees 1,000. The liability is reducing. Liability reduces on the credit side. Investments are to be brought down to the market price, it being rupees 3,200. Investment 3,200. Now you have to prepare the journal entries, capital accounts, and the opening balance sheet, and also calculate the new ratio. So first of all, let us calculate the new ratio. In order to find out the sacrifice ratio and give the treatment of the goodwill, we have to find the new ratio. Now the new ratio will be the new profit sharing ratio. For that we know C takes 2/7 share. C is given 2/7 share. So if C takes 2/7 share out of 1 share, that means 1 minus 2/7 is left for the other two partners. The remaining share is 5/7 share for A and B. So nothing else is mentioned. We have discussed, girls, before, when nothing else is mentioned about the new ratio, the old ratio is equal to the new ratio. But the share of profit now will be the share after giving the share of the new partner. The ratio of distribution of profits remains the same, that is 3/5, 2/5. But now he gets 3/5 of this 5/7 share. He gets 2/5 of this 5/7 share. left after giving 2/7 share to C. So these are the shares now acquired by them: 5/7, 3/7 and 2/7. The ratio thus becomes 2:2:2. The new ratio is 3:2:2. Now we have to make the journal entries. In this question you have not been asked to make the revaluation account. You have to make the journal entries. Nothing different at all. The assets, in case assets increase, freehold premises, it is freehold premises, increase in the value of the assets, increase in the value of assets or decrease in the liability, it is that asset or liability to revaluation. Whenever the revaluation account is to be has to become on the credit side, it will be to revaluation. When the following items come on the debit side, it is revaluation account to those things. So freehold premises, provision for doubtful debts to revaluation with the respective amounts. Then revaluation account to machinery and plant and machinery we call it otherwise, to stock, to investments, increase, that is increase in the value of assets. Whenever increase in the value of assets or anything that increase in the value of assets or decrease in the value of liabilities, then revaluation account will be debited. Revaluation to machinery, stock, investments respectively, whatever. Revaluation to transfer of provision of profit, in case profit, so to their capital accounts. In the sacrifice ratio, we know the new ratio, we know the old ratio. This is cash to seize capital to premium for goodwill, the goodwill that is brought by the new partner. In the sacrifice ratio, in case sacrifice ratio comes out to be gaining in for one partner, we make the no change, but that comes in the gaining ratio. Premium for goodwill to A's loan account and B's loan account, very clearly it has been mentioned. So whatever he brings will go to the loan account of the partners. It is not the capital or the current account here, it goes to the loan account. It has been specified in the question. So premium for goodwill to A's loan account to B's loan account, 1920 and 2880 respectively. Now after this we make the capital accounts.